Just had terrible news about the housing market with a complete disastrous miss in the amount of new home sales. Folks, the real estate market is at the beginning of a downtrend. It's a downtrend that on this channel I have been warning about since January, because not only have I been a real estate agent and a broker for over 10 years, but I've also been a real estate investor for over 10 years. And folks, the writing is so clearly on the wall that real estate prices are going to be negative year over year when we look back in 2023 to 2022. Now it's just a matter of how much. Let me give you the data. Then I want to qualify this data a little bit and talk about some things that you can track to make sure you're aware of what's going on in the housing market. Keep in mind, if you want everything that I know about property management, rental property, renovations, real estate investing, going from zero to millionaire in real estate investing, I have programs linked down below with a coupon code that expires on the 26th of this month. Make sure to take advantage of that linked down below. You can even bundle the various different programs together if you'd like. We also do fundamental analysis in my live streams for real estate included. Now, new single-family homes, home sales, fell 12.6% in July. That's down to an annualized pace of 511,000 homes of new homes that would sell every year, compared to the expectation of 575,000. It's a big miss, and it's the sixth time this year we've not only had a decline, but a miss. And it's the slowest pace since 2016. Construction has slowed, cancellations are up, applications for mortgages are plummeting, and inventory is finally starting to skyrocket. In fact, if you take a look at housing supply, take a look at this particular chart here. This is the new single-family home supply chart. We are back at 2009 and 2008 levels. This is not a sustainable chart, and it's not a sustainable area to be in within the housing market. And that's because here's what happens when it comes to real estate. Real estate's very, very slow. But real estate follows a very simple pattern. The first thing that happens is interest rates move, and they affect affordability. And either interest rates move or loan conditions move that take away the opportunity for some people to be able to qualify. That's what started in the Great Recession, as we started seeing some banks realize, oh, wow, we just lent money to a bunch of people who really shouldn't be lent this money. Let's tighten a little bit. As soon as you see lending tighten, whether interest rates go up or lending standards tighten, affordability goes down. That removes buyer demand. And one of the most important things that I hear that I think is such a great misconception is that there's more demand than there is supply, and therefore prices keep going up. That might have been true at the beginning of the year, but if you're still saying that, you're missing the point. Because here's what happens. Let's just say that you have a typical equilibrium. That means you have the same amount of sellers as you have buyers. Well, then prices should be relatively stable, maybe increasing at a nominal pace of 3 to 4% per year. Fine. But what happens when you have an excess amount of buyers and too few sellers? Well, in that case, prices go up more rapidly, potentially as much as 20% in a year, like what we've seen recently, right? Which is quite shocking and also quite exciting. It leads to a lot of FOMO for the real estate market. Well, the first thing that happens when buyer affordability gets crimped by higher interest rates is this excess demand goes away. It gets pushed down. Lowe's, and I know it might seem ironic that Lowe's would give us a statistic on this, but 90% of their customers are home buyers, like related homeowners or landlords related to homes, customers over at Lowe's. They suggest that the excess buyer demand used to be somewhere between 20 to 27%. And because interest rates have gone up about 3% now, and we know that for every 1% that interest rates go up, we see buyer purchasing power go down about 10%, we actually expect that this excess buyer demand could have been reduced by about 30%, which would actually then bring us to a lower level of buyers than what we've previously had. At the same time, we're seeing inventory increase. And so now you're actually flipping the script. You're going from potentially this feeling of excess buyer demand to actually going to excess supply. And now, even when this happens, I scribbled the wrong one, there we go. Even when this happens, it still takes time for real estate to react. Now, that reaction has already happened. The greatest decline that we've seen in home prices on a month-over-month basis during the Great Recession was 1.9%. But it's already started in this cycle. And you can track that by going to the Redfin data center. You can see that here, we had a peak of about $395,000 for resale homes. This is not just new construction that's seeing price reductions, but it's resale homes. We had a peak closing price of $395,000 throughout the entire country. That is now down over 5% already in just 3 months. We are on a similar trajectory as what we have seen at the early parts of 2006 and 2007, when the real estate market began to turn. Now, we don't actually expect to see a mega real estate crash where we see prices decline 30 to 50%, mostly because home buyers and homeowners who are existing homeowners still have substantial homeowner equity, and the qualifying that's required in order to own homes is so stringent today that you'd really have to see a substantial amount of job loss to really see a mega 30+% crash in the real estate market, in my opinion. But could we stand to see a 10 to 25% decline as we get more sellers potentially FOMOing their sales onto the market and less buyers buying for fear of getting screwed? Absolutely. In fact, that fear is already taking place in the market. And that is what we covered last week when I covered the housing market last week. We talked about how fear is creeping back in. Not only are institutions like Wall Street buyers pausing their purchases, but you've got companies like Redfin and Opendoor dumping their inventory because they realize they have too much of it. By some accounts, Opendoor has as much of 20% of the active listings on the market right now in Phoenix, Arizona. That's insane. That's asking for massive, massive drops in areas like Phoenix. You've got in areas like Boise, Idaho, which was considered a Zoom town. A lot of folks who wanted to Zoom to work went to Boise, Idaho. Anyway, over 70% of listings have a price reduction. And I want to share an anecdote here of one of the fascinating things about how sellers' mentality operates. Seller mentality is really such that, and it's a terrible thing, but seller mentality is really such that sellers will look at comps. They'll look at this sort of data. And let's say they have a median home. They won't price their property what we call ahead of the running deer. Like when we say shoot ahead of the running deer, you might price a property here at $369, like right here, right? To try to sell your property before the actual value of it goes below that. Maybe you could even get multiple offers if you did that, right? Because remember, folks, just because a property has multiple offers, and just because the comments come up all the time, oh, but properties are still getting multiple offers in my town. Yeah, well, so do eBay listings when things are underlisted. Anything underlisted should get multiple offers, okay? It comes down to the actual value. If something is listed for $500,000 and it's worth $369,000 or $374,000, it's not going to get multiple offers. If something is listed for $299,000, it'll get 50 offers, even in this market. Doesn't matter. But anyway, the point is, most sellers do not shoot ahead of the running deer. They won't price their property for $269,000. Instead, they'll do this interesting phenomenon. Well, it's not much of a phenomenon. It's just greed, really. And they'll price their property for $399,000 because obviously their property is better. And what happens when they price their property for $399,000 is the market continues to fall. And now the market potentially goes to $349,000 for the value of the home. And then the sellers after 60 days are like, all right, let's drop the price to $379,000. Doesn't sell. And then the actual value goes down to $339,000. And then they drop the price to $369,000. And notice how they're chasing the market down. But there's another problem that comes out of this. And the other problem that comes out of this is while this is happening and these price drops are happening, you're actually increasing substantially the amount of inventory of resale properties on the market. In most markets that I look at, that I study on a regular basis because I have a real estate company that's getting ready to launch, and this real estate company will be doing a lot of shopping for real estate. So I am personally very, very attuned to the real estate market and the changes that we're seeing. But what happens is, as inventory increases in almost every single market that we're looking at, we're also seeing price drops skyrocket nationally and in virtually every single market that we're looking at. And this is the precursor to a continuation of prices declining. Now, by some accounts, we could get month-over-month volatility where, oh, did prices go down one month and then they went up a little bit the next month? Maybe. And that can happen. And this is why I want to give you a better indicator that you should pay attention to. In my opinion, the critical threshold for real estate is anytime the 10-year treasury yield, which you could just go to cnbc.com, click on bonds at the top, and then click on 10-year. Anytime you see this number over 2.75%, it means we're going to have interest rates at such a high level, somewhere around 5.5% to 6%, that we are going to see real estate prices come under pressure. Now, there was actually hope that real estate wouldn't come under pressure because take a look at this. In July, we actually saw interest rates, or the 10-year, fall all the way to about 2.59%. And what was remarkable about that was there were rumors that maybe the 10-year treasury would fall all the way down to 2%. And if that happened, the real estate party could keep going because we would see mortgage rates back to 4%. Folks would be very, very excited to have cheap interest rates again compared to the 6% many people were qualifying for. Unfortunately, that decline stopped. And now we have an increase of these 10-year yields again to right now above 3%. And here's the thing. The longer these interest rates stay above 2.75%, the more time the housing market will have to adjust to higher interest rates. The more time the housing market has to adjust to higher interest rates means more price drops, more inventory, more seller fear of getting top dog pricing or top dollar pricing and getting excited to sell properties. The more fear you have with buyers, the more you end up seeing selling prices come down. And the more you see selling prices come down on a month-over-month basis, which we're already seeing that decline, the more self-fulfilling the fear becomes. The more prices decline, and the more people say, oh wow, prices are down 5% already from their peak, and it's only been a few months. Imagine where we're going to be next year. It'd be an easy 10 to 25%. Well, in that case, and that's of course my opinion, but in that case, you'll create more fear, which will self-fulfill these price reductions and ultimate cheaper closing prices. And again, my argument is that the critical price point is 10-year treasury above 2.75. The longer we're at 2.75, the worse and more self-fulfilling this real estate slowdown becomes. Now, some folks make the argument that a slowdown in the real estate market will affect our GDP. And this has merit due to something called the wealth effect. The wealth effect suggests that if most Americans hold most of their wealth in their homes and they start seeing their wealth decline, they might actually start spending less. Now, while I agree that it is very likely American consumers will be spending less, and we could be in a technical recession, not just for 2 quarters, but potentially 4 quarters or 6 quarters or 8 quarters, which is sort of a very shallow but elongated recession as we compare to these high sales numbers that we've had before with consumers. The industries that I think are most at risk are industries related to directly homeowner spending, which generally consumers do not spend money on their homes when home values are falling. In fact, Home Depot in their last earnings call mentioned that individuals who spend money on their homes while prices are going up don't see that spent money as an expense, they see it as an investment. But that U-turns when the market is falling, and every dollar spent on a home is now seen as a loss because you're spending money on something that's going down in value. And in my opinion, we're going to see a substantial slowdown in not only home prices, as long as these 10-year treasuries stay above 2.75, but we'll also then see a subsequent slowdown in building materials, lumber, solar panels, solar inverters for homes, anything related to services around homes, whether that's handyman services, handy person services, construction, contracting, painting, plumbing, electrical, whatever. We might think there's job security. Yes, there's job security in plumbing for fixing things that leak. But for upgrading that old plumbing to copper, we're going to have to postpone that. Upgrading to PEX, going to have to postpone that, right? So this is where if I were a contractor, I would be preparing for the potential slowdown in contracting business activity by making sure I'm running a lean and tight ship and I have ample cash reserves and I'm not heavily leveraged. But the same is the advice that I would give to individuals who are potentially considering buying real estate. Get out of debt, increase your income, and get educated on real estate and on buying wedge deals. Because no matter the market you're in, I personally believe that you can become a millionaire by buying wedge deals. Wedge deals are, again, no matter what the market does, your goal becomes buying properties about 20% under market value. This is the wedge. And the way you accomplish this is by targeting very specific aspects which are different for single families and multifamily. For multifamily, you have to get what I call rent wedges. For single family, you have to get condition wedges. Low rents, bad condition, but you have to strategize this appropriately. And for all the details on this, I encourage you to check out the links down below. Use the coupon code. And folks, good luck out there.